Ever wondered what inflation is and how it works? Well, let's break it down. Inflation is the rate at which the general level of prices for goods and services rises. As a result, the purchasing power of your money falls. Imagine this. Yesterday you bought a coffee for $2, but today, that same coffee costs $2.10. That's inflation in action. The same amount of money buying fewer goods and services than before. Stay with us as we delve into the causes of inflation. So, what causes inflation to occur? There are primarily three culprits behind the inflation phenomenon: an increase in demand for goods and services, an increase in production costs, and an increase in the money supply. First off, when demand for goods and services outpaces supply, prices tend to rise. This is basic economics, folks. When more people want something that's in limited supply, they're willing to pay more for it. Secondly, if it becomes more expensive to produce goods or services, say because of a hike in wages or the cost of raw materials, then those increased production costs are typically passed on to consumers in the form of higher prices. Lastly, when the money supply increases without a corresponding increase in goods and services, each unit of currency tends to be worth less. In other words, more money chasing the same amount of goods and services can also lead to inflation. Let's start by discussing demand pull inflation. Demand pull inflation arises when the demand for goods and services exceeds the supply. Picture a bustling market where everyone wants the same item, say a golden apple. But there's a catch: there are only a handful of these apples available. So what happens? The price of the golden apple begins to climb, as eager buyers are willing to pay more to secure one. This is demand pull inflation in action, where heightened demand leads to rising prices. Now let's move on to cost push inflation. Cost push inflation occurs when the costs of production increase. Picture this: you're a producer, and suddenly, the price of raw materials skyrockets or wages rise significantly. Naturally, to keep your business afloat, you'll have to pass these increased costs onto the consumer, which leads to higher prices for goods and services. It's like a domino effect, where one tiny push at the start can lead to big changes down the line. Next, we'll discuss money supply inflation. Money supply inflation happens when the money supply increases. Picture this: more money floating around can make people feel wealthier, and this can spur them to spend more. As this increased spending intensifies, demand for goods and services also rises. But if supply can't keep up with this heightened demand, businesses may raise prices, leading to inflation. It's a bit like a seesaw. When the money supply goes up, the value of each unit of currency can go down. Finally, let's discuss the effects of inflation. Inflation isn't just a theoretical concept, it has real-world effects. When inflation occurs, the most immediate effect is a decrease in your purchasing power. Imagine that yesterday, you could buy an apple for $1. Today, due to inflation, that same apple costs $1.10. Your dollar doesn't go as far as it used to, and that's a direct result of inflation. But the effects of inflation extend beyond just what's in your wallet. It also impacts the broader economy. When inflation is high, interest rates often rise as well. This makes it more expensive to borrow money, which can slow down economic growth. Furthermore, inflation can lead to increased unemployment. As businesses face higher costs due to inflation, they may need to cut back on expenses. And unfortunately, that often means reducing their workforce. Now that you know more about inflation, you can better understand its impact on our economy. We've covered a lot of ground on the topic of inflation, from pinpointing its causes, demand pull, cost push, and money supply, to dissecting its effects on our economy. Thanks for watching. If you have any questions, leave them in the comments below. Remember, understanding economics helps us make informed decisions.